The most common crime that I see on a daily basis is where people overstate their deductions on a tax return. In essence, this is 7201 income tax evasion. A good explanation of this can be found under Zacher versus United States, where the Eighth Circuit defined the following. A consistent pattern of overstating deductions is income tax evasion. In Zacher, the court stated, such a consistent pattern exists when, for example, the taxpayer overstates casualty losses. The sales tax deduction claimed exceeded the amount of sales tax paid, and he overstated his repair costs. Evasion can also be found where you purposely understate your income, you claim credits that you're not entitled to, or you don't file returns where you're required to, under a case called Spies versus United States. I've already said earlier in this series that the government will establish willfulness through circumstantial evidence. Circumstantial evidence are indirect facts that, when weighed together, tend to indicate to the government that somebody willfully intended their actions. Circumstantial evidence need not be slam dunk badges of fraud. It can be actions when viewed individually are legal, but when combined together into a series of actions start to look illegal. For example, it is not illegal to run an all-cash basis restaurant, for example. But the fact that a business is all cash, when added up with other factors, could indicate that tax fraud exists. Matter of fact, here's how that could happen. You're being audited. They show up unannounced at your business. There's a safe in the corner of the room. They demand that you open the safe. They find $10 million of cash sitting in that safe. If you haven't reported $10 million worth of taxable income in the recent past, that's how a badge of fraud could occur. Here's another example of how independently legal actions could be added together to show indirect evidence that somebody committed tax fraud. In Voight, the government took technically legal actions on the part of a taxpayer and added them together into a pattern that showed willful intent to commit tax evasion. In U.S. versus Voight, the taxpayer 1 decided against purchasing some jewelry with cash when he discovered that a report to the IRS would be required to show the government that there was a cash purchase. This businessman went further in requiring his clients to fill out certain confidentiality agreements that forbade them from disclosing details of his transactions with them. And he maintained an overseas bank account. These individual actions were added together to show fraudulent intent. The court stated that it had no difficulty in believing that a jury could weave these facts together and create an inference that the taxpayer intended to commit tax fraud. The strongest evidence the government can put together that's very persuasive and in front of a jury is several years worth of tax deficiencies. In other words, there's the tax you reported on your tax return, there's the tax you should have reported, and between the two, there's a deficiency, a difference, an understatement. The strongest evidence they can also provide is what caused the deficiency. If they can put direct evidence in front of the jury, in other words, they can show specific transactions that led to an understatement of tax, and they can cast a doubt on your credibility by doing that, they'll do that. The government has several indirect methods of establishing the tax deficiencies. We're going to go through those now. One indirect method the government can establish a tax deficiency is to calculate your net worth at the beginning of a tax year, calculate your net worth at the end of a tax year, figure out what the change in your net worth was, figure out what the cost of your living expenses were for that year, the cost just for you to exist. If you got kids in private school, if you got a house that's 1 block from the beach, if you're driving a Maserati, if you own an airplane, they can do the math on what all that cost, and then they can compare the beginning and ending net worth for a year, figure out what the increase in your net worth was, figure out what it costs for you to live the lifestyle you've lived, and extrapolate a tax deficiency. The amount of income you reported on your tax return versus the amount of income it would have taken to live the way you lived for that year and to increase your net worth from its beginning value to its ending value. The government will take into consideration non-taxable sources of income during that year. Maybe an inheritance came in that year, that would be non-taxable. Maybe you went out and borrowed money in that year, that would be non-taxable. The government will figure this in and determine a deficiency anyways. The expenditures method is basically a cost of living test. This method focuses on the cost that it would take to cover your personal living expenses. This is readily determinable by looking at your debit cards, your credit cards, every type of financial statement that comes through your home, your banking activity, and the government can tell what it costs for your lifestyle. Plus, you're interviewing you, observing you. Since one possible source for you to cover these expenditures is wealth acquired in a previous year, the government will also incorporate the net worth test in making this determination. In other words, what was your net worth at the beginning of the year? What was your net worth at the end of the year? What were your expenditures for the year? They'll come up with a tax deficiency in that manner. The government will also look at any assets you purchase in that year. What did it cost for you to acquire the assets you acquired in that year, to live in the manner you lived, and to change your net worth from what it was at the beginning of the year to what it was at the end of the year. Here's a method that I've seen used in every audit I have ever been a part of. It's called the bank deposit analysis. The government will take all of your accounts, whether they be brokerage accounts, savings accounts, checking accounts, any type of an account, and they will add up the deposits into all of those accounts for the year, and that represents your income for the year. They'll compare that income per these other source documents to the income you reported on your return and look for underreported income in this manner. All it takes is $10,000 of unreported income for your case to be referred from a civil auditor to a technical fraud advisor. There's 2 of them in California. Their sole job is to determine whether to pass on that referral to the Criminal Investigation Division to take your civil audit and ramp it up into a criminal tax investigation. If this happens, you won't hear from that civil auditor anymore. They will just disappear. I do a whole video series on when do you know that your civil audit has turned criminal. You might want to see that one. The government routinely uses this same methodologies with entities such as LLCs, partnerships, and corporations as well. The government's very fond of using this method. It's called the specific item method. This is where the government will look at specific reporting surrounding specific transactions and identify transactions that underreport income, transactions that overstate deductions. They'll look for a pattern of these type of transactions and claim that your books are cooked and that's why the return missed by a mile between the tax you should have paid and the tax that you did pay. What you really need to know here is the government is not put to a burden of determining exactly how much income you omitted in criminally prosecuting you. All they really have to do is prove that there was a substantial amount of income that was underreported. Okay? They don't have to get it exactly to the penny. If your case happens to be passed on from a civil audit through a technical fraud advisor to the Criminal Investigation Division, the Criminal Investigation has some extraordinary techniques they can use to criminally investigate you. Let's go through those. When appropriate, criminal investigation special agents can employ surveillance, they can issue search warrants, they can implant undercover agents into your business or into your life. They can utilize scientific experts to aid in a criminal investigation. These are extraordinary techniques. For example, the Criminal Investigation Division has been known to sift through a target's trash at their business, at their home. Case law has already held that you have no expectation of privacy in the trash that your business throws off or your home throws off. Once that stuff's out at the curb or out in the dumpster, it's fair game for the government to look at. Now, a good defense attorney can sometimes get evidence suppressed where it's obtained in a legal manner. Here's an example. In one reported case, the IRS got a search warrant to search somebody's real estate business. They went in and they grabbed every document known to man out of that real estate business, and the attorney for the target was able to get all of that evidence suppressed because the wording of the search warrant was overly broad. At trial, none of the evidence that they obtained through that defective search was allowed to be presented to the court.